All right. So, chapter 13, mortgages. Do you guys know what mortgage means?
Money borrowed, basically. No? To pay off.
No, ask what it means. The word itself.
Oh.
Looks Latin.
What the word itself means. Look right here.
Mortgage.
Right. So if you only see this, what does it mean?
More?
Portozeiro. Tô brincando.
All right. It's a Latin word. Mort. You all speak Latin languages. So what is...
Death.
Thank you.
Oh, right. I wasn't getting
Like
that one.
muerte?
Like muerte or
I
mort?
said mort.
Yeah, but we're in English here, right? So...
Don't even ask me about gauge.
Okay, what?
Gauge. I was gonna say Luke.
Gauge? Wow. All right, gauge. What does gauge mean? What does it mean to engage?
Connect, basically, to
Connect?
like.
Oh,
bond.
you engage. Okay, got
Yeah.
it. To commit, right? So the word gauge actually is French.
It's good.
You know what I meant. I was trying to say.
That's when you're engaged, right?
No,
That's
no,
what you're
no.
saying?
No, not
You
that.
connected. Holly's having the time of her life. Come on.
Yeah, just, yeah.
She's like, anyone but
She
me.
doesn't want to leave. She's
No.
just like, I'll just stay here.
I thought you were going to say gay.
That's what he said. You went Brazilian. Gauge. For the record, that's not what I meant. Because when I went Brazilian, I didn't mean anything. I just meant to go with the ch at the end.
Yeah.
Discrimination.
All right, so it's pledge, or to get even better,
Oh gosh.
grip. So, here's the thing. Mortgage means death pledge or death grip. Now, I believe strongly in etymology. Etymology is the study of origin of the words, okay, where they came from. I believe strongly in that because if you understand what the word means or where it came from, you'll understand what the process is or what it really relates to, right? So mort is death. Now, the good thing or the good news is that it's not your death. You're talking about death of the loan, okay? So what you've done when the mortgage is you've pledged, right? You've pledged a property until the loan dies. Okay? So you've pledged the property until the loan dies. So the bank has a grip on your property because if you don't pay the loan, what can you do?
Take it.
Take it from you. Okay? So death pledge. You pledged the property. You said, bank, give me money in exchange for the house. And most people get confused because you don't get the house unless you have a mortgage, right? No, you don't get a house unless you have a loan, which is a promissory note. And that's where the confusion comes. Oh, I have a mortgage. No, the bank has a mortgage. You have a promissory note. You said, Bank of America, for instance, I promise to pay you X amount of dollars, but if I don't, you can take my house. You pledged the house.
It's like
You
your real
mortgaged the house.
property that you're running before. Real property, personal property.
Yeah,
But,
right.
you know, this real property is not your property. Because, you know, if you don't pay the mortgage or you don't pay,
They come and get it.
yes.
Yep. So they foreclose on you. Okay? So if you don't pay this, they foreclose on this. They take the property away from you. Does that make sense?
Yes.
So mortgage, death pledge, or death grip. The bank has a grip on your property until the loan dies. Balance reaches zero. Okay? So as soon as the balance reaches zero, right, the bank no longer has a grip on your property. They have to release, and now the property is solely yours, completely separate from the bank. You got it?
Yeah.
Once balance reaches zero, the loan dies.
Okay. But what if you don't pay I mean, how can I say the taxes? I mean,
Oh, no, that's different.
That's different.
So mortgage is a relationship between the lender and you.
okay.
Taxes is separate. So if you don't pay the mortgage,
Mhm.
right, the commitment in the mortgage, the promissory note, the loan, the bank comes and takes it. If you don't pay your taxes, the town comes and takes it.
All right,
You got it?
got it.
It's actually a very good question. It's probably the first time I had that one. All right, we're good?
Yep.
So, at the bottom it says note and mortgage. So we already know what mortgage is, right? It's the pledging of the property, yes?
Yes.
Good so far?
Yep.
Okay. But the very first one that says there is a note. What is a note? It's a promissory note. It's a document that says, I promise to pay the money you've lent me. Okay? Very important that you understand. It's highlighted there. It says the note creates the personal obligation. The mortgage creates a lien. Okay? You guys remember what a lien is?
It weighs, it's something on the property.
Something on the
Like,
property.
like the weight on the property.
Weight
Yeah.
on the property, like an encumbrance maybe.
Yeah, it leans on the property.
It's not a bad one. It leans
It
on the
leans on the
property.
property.
I like that. Camera's doing autofocus again. Great.
You gotta stop leaning.
I was leaning and that thing went like, what's going on? All right, so that's good. That's like the movable property. Yeah, chattels or cattles. There you go. Hey, whatever works. I like that. So lien, you lien on the property, creates a weight or encumbrance, slows down the ability to sell, the value, the usage, all that stuff, right? So a mortgage is a type of lien. Liens are money usually. So if you have a question where it talks about what type of lien is this, right? It's a mortgage. So you go look for the answer that says mortgage, or if it talks about mortgage, what type of encumbrance is it? It's a lien. Anytime there's money, lien, money. Okay?
Mm-hmm.
So it says right there that the mortgage itself is a security instrument signed by the borrower, which states, if I don't keep my promise, I already went over this, I promise to repay you as agreed, and you may foreclose. That means have the property sold at auction, right?
Mm-hmm.
Then it says it is the borrower, I already explained that, but we're just going to go over again. It is the borrower who signs the mortgage, who does the mortgaging. It is incorrect to say to a buyer, oh, we'll find a bank to give you a mortgage. No. What the bank gives, as I was just saying, is a loan. And that's what a promissory note does. The bank gave you a loan. And in return, so in exchange, it takes a mortgage. That means we give the property to the bank, we pledged our property to the bank, and now they have a grip on it, like I said earlier, right? So who's the mortgagor?
The owner of the property, apparently.
How do you pronounce it?
person
Mortgagor.
Mortgagor.
The person that's holding the mortgage.
Oh yeah? Who's holding the mortgage?
The bank.
What,
You as the owner hold the lien or the promissory note. Promissory, yeah, you hold it. Isn't the promissory note the?
There's no holding. You took money. It's different. All right, so.
Take them away from me.
You're gonna put two columns somewhere there. What you say? Got real quiet because they're actually writing something. Oh, are you reading?
And I was trying to chew.
That's why you're making that, not seeing the camera, that face.
Started sweating, trying to chew really quietly.
Okay, cool. So two columns. The one on the left says on top, give a property. The one, and at the bottom says receive money. On the right-hand side, the second column, you're gonna write receive the property, give up money. Ready?
Mm-hmm.
Okay. So, People on this side, they give up their property in exchange for money. People on this side receive the property in exchange for money. You got it?
Mm-hmm.
So on this side, we have lessor or landlord, right?
Mhm.
On the right side, you have lessee. So here's the thing. Landlord, tenant, right? Doesn't the landlord give up the space for the tenant to occupy?
Mm-hmm.
Yes. Doesn't the tenant give up money every month to the landlord?
Yes.
Good. So on this side, give up property.
Receive money.
This side, receive property.
Give money.
Grantor and grantee. Grantor is the seller. Grantee is the buyer. Doesn't the seller give up property when they sell?
Yeah.
Mm-hmm.
What do they receive?
Money.
Doesn't the buyer receive property when they buy?
Mm-hmm.
What do they give up?
Money.
Make sense so far?
Mm-hmm.
Okay. Now the complicated one. Mortgagor and mortgagee. Mortgagor, mortgagee. Who gives up the property?
The mortgagor.
Who's the mortgagor?
The owner.
Loan.
Owner. And what does the owner get?
Money.
A loan, money. Mortgagee, who receives the property or holds a mortgage?
The bank.
The bank as collateral, the grip, remember?
Mm-hmm.
What do they give up?
Money.
Money.
The loan, money. You got it?
Yeah.
So, in terms of logic, to be easier for you guys,
Owner.
owner.
Ooh, I never thought about that.
Got it?
That's good.
Seller.
Good.
Oh, I'm sorry.
The distinction is simple. Here it could vary. Here it varies. But in this case, it's always the owner. Got it?
I was gonna ask you to come up with a snappy one for the other side, but then you said it varies.
It varies. Because a landlord is the owner,
Mm-hmm.
a grantor is the owner,
Mhm.
mortgagor is becoming the owner. Right? Here, it's a tenant, it's a buyer, it's a bank. So it's difficult.
Gotcha.
What you need to remember is that the E receives property, gives up money. OR is the owner, gives up property, receives money.
Gotcha.
Was that good or is that good?
Yeah.
Yeah, that was good. So, or always,
And that's why you ask the real estate instructor.
There
.com.
you go.
or is always gonna give up the property and receive money, and then the E's are always gonna receive property and give up money.
Easy, right?
The way you broke it down, yeah.
I always do this because it gets confused. Most people think the mortgagor is the bank. They fall for that.
Yeah, that's what I thought.
They're the lender. Mortgagor is you that gives up your property in exchange for the lend, the money,
Money.
the loan. Got it?
Mm-hmm.
Once you pay it off, the mortgagee must release the mortgage, so the property is now yours. Okay. Release the grip. Next page. So next page we have hypothecation. You ever heard that before?
Qualification.
Never heard that? Really?
I don't think so.
Latin-based language, Latin-based language. You
Okay.
never heard hipoteca?
Yes. Brazilian.
Mm.
I never did.
Hypothecation. Really? Never?
Hipócrita?
Até esqueci que era o significado
Just
de
saying,
hipoteca mesmo.
hipócrita has some
Mas não tem que ter
application.
estúpido.
So does hippopotamus.
Yeah, I was gonna say that next.
I never heard of it.
Hipoteca?
Eu esqueci o significado.
So that- Okay, so hypothecation, if you're on the next page, hypothecation says, is the term used to describe the pledging of property as security for a payment of a loan without surrendering possession of the property. So hypothec in most countries is the lending itself, it's the mortgage. Right? Here we have different words for the same process. But hypothecation is simple. If I go by this, right? And I say, you know what? I want to pay in installments. And they say, okay. And you bring this home, that's hypothecation. This is the collateral, but it's in your hands. You did not surrender it in order to pay for it. Does that make sense? But most of the times, if we need money, right? If you need a loan, you go to a bank, they ask you, what do you have to give up? What's the collateral, right? So if you go to a pawn shop, for example, they do the same. What's the collateral? Right? And I say, okay, I got a tablet, I got a phone, I got a computer. They're worth roughly $2,000. How much are you going to give me for it? And they give you like $400, right? And you got to pay those $400 back with interest to get your material that's worth $2.
Yep.
Does that make sense?
Yep.
But I had to leave the computer, I had to leave the tablet, I had to leave the phone in order to get my money.
They're like the pawn shops, you know, like.
Pawn shops, that's what it is. So I left it there. That's not hypothecation. Hypothecation is I still have the laptop, I still have the tablet, I still have the phone while I'm paying for it. Okay, so it says without surrendering possession of the property, it's still mine. With cars and houses, that's what's happened. What happens, right? You get the car the first day you walk into the dealer, right? You sign a promissory note, but you get the car, don't you? The car is hypothecated. There's a lien against the car. So if you don't pay, what can they do?
Take the car back.
They take the car back, right? With a house, they don't take the car back. What they do is enforce the mortgage, what I had here before. But the process is the same. You live in the house from day one while you're paying for 30 years. That's hypothecation. The property is in your possession as you're paying. Got it?
Like phone installments now. Instead.
Like the phone installments now, that's a type of hypothecation, even though it's more like a lease, but yeah.
Yeah.
But you can think of it that way if you want.
Yeah.
You got it? So what you need to underline is what's in green, hypothecation, pledging of property without surrendering possession of the property. I don't know, he got lost. Trust deeds. So a trust deed is very similar to a mortgage. You can write similar to mortgage. You find these in non-judicial states. You find trust deeds. In judicial states like New Jersey, we have mortgage. The difference between them two is what I have highlighted there, is that with a trust deed, the bank bypasses the whole foreclosure process. Like judicial foreclosure. It's still a foreclosure, but they bypass the judicial foreclosure, meaning they don't have to go to court.
So they can take it back quicker.
Correct. So with a trust deed versus a mortgage, trust deed is you stop paying, right? 3 months later, they give you a notice of auction. And then another 2 or 3 months later, we're at auction. So in less than 6 months, let's say, from anywhere from between 120 to 180 days, you could lose your property. With a mortgage, they have to go through court. So they file a summons and complaint against you for foreclosure. Then it takes another 45 days, 30 days, 35 days plus 10 days of maybe a decision. Then it takes another X amount of months for the judge to say, hey, go send it to the sheriff. Then it takes another X amount of months for the sheriff to say, okay, we have a date for us to sell the property. Does that make sense?
Yeah.
So traditionally, in New Jersey, it takes roughly 12 to 13 months from the moment you stop paying to the moment you lose your house, traditionally. That's the process, 12 to 13 months versus the 6 months with the other. But then there's stalling. Then there's let me try a loan modification. Let me try a short sale. Let me try negotiating other alternatives with the bank, right? Or the fact that the bank has so many foreclosures that they can't proceed that fast. Or the fact that the court has so many foreclosures that they cannot proceed that fast, right? So on average, it's taking roughly 1,039 days in New Jersey to foreclose.
Oh.
So we just went from 6 months with a trust deed to 3 years with a foreclosure in Jersey. you understand what I'm trying to say?
Mhm.
Cool. So that's the biggest difference. Trust deeds operate very similar. The difference is judicial or non-judicial states.
What would be a state that has
Your neighbors.
Pennsylvania? Oh,
They're mixed, actually. Some states you can have mortgages, you can have trustees. It depends on the lender, but they allow the trustees. Virginia is the same thing. I found out that the hard way. I was helping somebody with a loan modification. It was my very first person I was helping outside of Jersey,
Mhm.
and they had to be in the non-judicial state. So as we're filing stuff to the bank, they're ready for foreclosing. They're going to
Wow.
auction.
Oh.
That's crazy. That's bananas.
Yep. You got it?
Mm-hmm.
So what's the difference between trust deeds and mortgages?
Skipping the judicial process.
So faster
Faster
foreclosure. Okay.
I'll put down. Similar to mortgage without the judicial system.
Yeah, you just skip the whole 2-3 years.
Yeah. They'll find a place to live. They'll be all right.
It's plenty of burgers.
Provisions of the note or bond and provisions of the mortgage document. It's very simple. The note is a promissory note, so the only thing that's there is the terms of the loan. Simple, right?
Mhm.
And both parties must sign, or all parties must sign. Provisions of the mortgage document, because the mortgage is a security, then the mortgage document describes the value of the loan and the property that's being pledged. Got it?
That's the
Provisions of the mortgage document.
okay.
Does that make sense?
Yes.
So provisions of the note describes the loan itself.
Mm-hmm.
So you're gonna have, here's the payment, here's the interest, here's everything regarding the loan itself. The mortgage will say, here's the property that served as collateral for a $200,000 loan.
Okay. Terms of the loan, terms of the property.
Yeah, questions?
You answered my question.
I answered your question. Ali?
No.
When you said that, my mind was like, what?
I'm speaking Japanese to you, it's okay.
I was like, ying, ling, ling, ling. I was like, whoa, what's going on over here?
All right, duties of the mortgage borrower. Now, if you borrow money to buy a house, you already know pretty much what your duties are, what you're supposed to do, right?
Mm-hmm.
If you borrow money, you're supposed to
Pay it back.
pay back. That's the first bullet point. If it's real estate, then you should also pay something called taxes, real estate
Mhm.
taxes, right?
Yeah.
That's the second bullet point. Third bullet point says you have to maintain insurance, right?
Yeah.
Just like your car. If you have a car and it's financed, what is required?
Full coverage.
Different than the liability, right?
Yep.
So this you guys know, basic. On the right-hand side on top, check this out. And if you have a mortgage, if you go through the mortgage, it's written right there. It says, obtaining the lender's authorization before making any major alterations on the property. Look at her face reading it again and again
Yeah,
and
I'm
again.
like, wait, what?
She already put it on loop. Let me read this again. Obtaining the lender's authorization before making any major alterations on the property.
Are you serious?
Yeah.
I never knew that.
Did you read your mortgage documents?
No.
Okay. It's there. See, the problem is people don't read contracts. All right? And you're not the only one. Most people don't know about this.
Yeah, I never knew.
And look, it's very simple. Why would the bank need authorization for you to make major alterations on the property?
Because of the value.
It could affect the value, yeah. And if I lend you money, if I gave you money, don't I have an interest in the property?
Yes.
Yeah.
So I want to make sure whatever you do
I'm
upholds the value of the property. So all I want as a lender is for you to tell me that you went through the legal ways to get it done. You got your permits, you got the CO, moving forward. Does that make sense?
Mm-hmm.
Because if you're finishing the basement without permits and there's a fire because of your amazing YouTube electrical skills or HGTV plumbing skills, right?
Hey, they're good, right?
They're great, but you're just watching and trying to duplicate, right?
Yeah.
So if something happens because of that without a permit, without a CO, then your insurance might not pay the claim. If your insurance doesn't pay the claim, what happens to the property? You're not going to fix out of pocket, are you?
No.
Mm-mm.
So what can the bank recover in a foreclosure? Destroyed property. A third, a fourth, a fifth of the price. Does that make sense?
Mhm.
So for that reason, they ask that you obtain authorization. And authorization, all they want to know is, did you apply for a permit? Yes. Please submit a copy. At the end of it, did you get a CO? Yes. Please submit a copy. What is the current value of the property? Something like that. Does that make sense?
Okay.
So that's all. They don't want, can I do this? No. This is how you're doing it. That's all. Okay? The next one is, also under your duties as a mortgagor, maintaining the property in good repair at all times. Why? Why can't I destroy my property? It's the same concept. If I gave you money, I have an interest in it, therefore you have to uphold the value. Okay? So anything here that destroys my interest, like if you don't pay me, I'll foreclose. If you don't pay the taxes, city might foreclose. So you better pay the taxes so I don't have to step up, right? If you don't pay insurance and there's a fire, it will damage the value, again, of my investment. Obtain authorization before I make the alterations. Maintain the property in good repairs. And finally, something else that could affect my position in your property. Until the mortgage has been in place for 30 days, obtaining the lender's authorization before placing a second mortgage against the property.
What is junior lien?
Anything that comes after, we're going to talk about that in a second.
Alright.
But second mortgage or anything that's secondary to the first one is junior, smaller. Okay, secondary comes after. So what they're saying is, give us enough time to record the mortgage so that we guarantee the flag is there first. If new flags come along, they're second. Why is this important? We mentioned this in chapter 9. We mentioned this. If there's a foreclosure, who gets paid first?
I remember talking about it too.
Taxes.
Taxes, yeah.
Great answer. Who gets paid second?
The construction worker. No.
It's by order it was recorded. So whoever recorded first has priority. So what they're saying here is, if the second mortgage records first, then they are first mortgage.
Mm.
Does that make sense?
Yes.
So the problem is, I'm trying to tell you, don't go after a second loan until the 30 days have passed. Why? Because it gives me enough time to record my priority, to put the flag down
First.
as a priority.
Gotcha.
Okay? After 30 days, you can go contract with anybody else. If there's another flag there, no problem. At least I know my spot is secured as the first flag.
Mm-hmm.
Got it?
Mm-hmm.
Draw a little flag.
And then it says right there, failure to meet any of these obligations can result in the borrower's default on note. Any of these obligations. So what we're saying is, if you fail any of those, like payment, taxes, insurance, obtaining authorization before making repairs, maintain the property in good repairs, or getting a second mortgage, any of these failures, any, not all, any, I can come after the house. I can enforce that grip, that pledge, and take the house away from you. Now, why would the bank take the house away from you if you repair the property?
Because you had no authorization.
Because they're not sure if there's a fire,
Oh, that's him. But there's insurance.
but that's what it is. But if you did without a permit, without a CO, is the insurance going to pay?
No.
Probably not. So let me step in now while it has value.
Mm.
You got it? So at any point, see, a lot of people say, if I don't pay, they come get my house. Everything else I can do because it's my house. Nope. The moment they see, so it says right there, when this happens, the mortgage usually provides for a grace period, which is 30 days, for example, during which the borrower can meet the obligation or cure the default. If he or she does not do so, the lender has the right to foreclose the mortgage and collect on the note. So you did repairs without telling us how you did it and all that stuff, I'm going to foreclose on you. Okay? You're not maintaining your property, value is decreasing, I'm going to foreclose on you.
Okay, but now I have a question. So if they do that, can't you refinance and get a different mortgage?
If there's value,
That's what I'm saying. There's equity in the home.
maybe. How do you know there's equity if the house is done illegally?
No, I'm just saying. That's true. Yeah.
Because now you have to knock on City Hall's door and say, hey, I did some repairs, house is worth more, Yeah, you should have raised my taxes 5 years ago.
No, yeah, of course.
Do you see what I'm trying to say?
Yeah, yeah. But like, that's what I was thinking,
Yeah.
like, I mean, you can,
Because don't forget, for you to refinance or anything like that, depending on the lenders, they're gonna ask for that CO.
yeah.
So do you have a CO for that basement that was fixed?
Mhm.
You try to sell the house. Can you sell the house without the CO? Probably not. It depends on what the lenders ask.
I gotta take it apart.
You might have to take it apart. That depends on the town.
I don't know.
Yeah.
You know, it happened to you?
No, but my parents.
What, your mom couldn't appeal it?
No, what do you call it? It was thing.
All right.
Camera.
Hi, Mom. Hi, Dad. Is that what you want to do?
Love you.
He's doing it right there. Gonna have so much fun editing. Provisions for default. A mortgage may include an acceleration clause to assist a lender in foreclosure. If a borrower defaults, the lender has the right to accelerate the maturity of the debt. That means to declare the entire debt due and owing immediately. So, the regular path is you borrowed for 30 years. You borrowed $200,000. Okay? And the regular path is that every year, well, every month, but let's count years, let's say, you're going to pay down on the debt until it reaches zero. That make sense?
Mhm.
Yes?
Yeah.
So far? So the loan dies. You owe a lot, you owe nothing. 30 years later. Good so far?
Yes.
Mhm.
All right. Now, at the 15 year, somewhere around here, right? So 15 years, you defaulted. What does that mean? You stop paying, as an example, or defaulted any of these. But you stopped paying. So after 15 years, your debt is somewhere at 80% of that. Sorry, 80%. Because in the first years, it's just interest, so you still didn't pay enough, right? So 80% of 200 is how much? Great. So it's 160, yes.
Yeah, I was going to, you did give me a chance. It's just
So-
8 times
Look at me,
2.
I'm like, wait.
Sorry.
It didn't get me
Right?
silent for a second. I was
You
like,
say like
nope,
8
not me.
times 2. It's,
Yes.
yeah, I was going to say, but then you're so fast, you know, math.
No, but that's what it is. It's 8 times 2. 16.
Oh, the
And add a
point,
zero.
yeah, okay.
You just took a 0 out, right?
Yep.
All right. Chapter 22 is math. We're going to have fun. So, and we're just in the basics, man.
I can do this, but not like on the spot. Like I need my calculator, I need pen and paper. Old school, you know?
Gotcha. Old school, I need a calculator.
No, pen and paper, pen and paper, pen and paper. Pen and paper.
Carry the one,
Say it
carry
faster,
the two.
right? Say it faster. Pen and paper,
Pen
pen
and
and
paper.
paper.
Not make it big, not make it big.
Not make this is big. Wow. Wow. All right, so here's the thing. The mortgage payment, whatever you're paying here, was $1,500 a month. Okay? For it to be considered default, usually they give you 60 to 90 days before they start a foreclosure. So if you defaulted 60 to 90 days, right? Actually, we're going to assume just the 90 days altogether. Okay?
Okay.
So if all the 90 days, that's 3 months, right? What's 3 months at 1,500? Great, 4,500, yes.
Because he does this.
Okay.
Okay, so 3 times 15, yes. So
We have time, you know, at the test.
in the exam, we have plenty of time. It's just
Yes.
that it's such a short chapter, and we're 8:45 because we were waiting on Dick. So, Rick.
Richard.
Rick. So,
Okay.
4,500 that you're behind from the month payments, right?
Mhm.
So the question is, they're going to foreclose on you. Let me take this out of here. They're going to foreclose on you, right? They're going to take you to court and say, hey, you're behind 3 months. Give me $4,500 in court. Is that it?
No.
No. So what they do is they accelerate maturity. Here, it would have been 0.
No, it's
They accelerate it to here. So when they start a foreclosure action, they start for the balance of the loan,
Remaining balance.
remaining balance. So they don't sue you for 4,500. They sue you for the remaining balance, 160.
All in one shot.
Why? Because they don't know if by paying 4,500 you're going to get back on your feet. So you know what? Let me take all the money now, or force the sale of the house to recoup that money, rather than delaying another, I don't know how many months or years to get paid. Does that make sense? Or not? Well, eventually they get paid.
Yeah.
But
Yeah.
do you guys understand this?
Yes.
So maturity would have been at 30th year, right here.
Oh, breaks here.
They
Yeah.
accelerate.
Oh, Richard.
We're done. We're not. I'm just kidding.
Oh, I'm like, wait.
So they accelerate the maturity to the day of foreclosure. They accelerate the balance of the loan, the remaining balance, to this date. It's not what you defaulted on. They claim the whole thing. Good?
Mm-hmm.
Accelerate.
Yes?
But the
Question.
murder is,
Go,
okay.
go. Yes, ask.
No, I don't have questions, but it's,
Okay, got it.
She has to take it in.
yes.
Look, I'll put it this way. Let's say you have some food in the fridge, right? And you open up the food and it smells okay, right?
Mhm.
You warm it up, you start eating, everything's great, and then all of a sudden there's a piece that like, oh, I don't know, something's wrong here, right? You might take another bite, so another month later. That's what I'm saying. So one default, two defaults. You might take another bite. That's not good. Let me try one more just in case. So 3 months later, right? And you realize that there is something wrong with that food, right? What do? You keep on eating or you throw it out?
Throw it out.
Oh.
Mm-hmm.
Don't you throw out the whole thing?
Yep.
Not just the pieces you ate, right?
Right.
So here, they're not coming after the 3 payments that you defaulted that smelled bad, right?
Yeah.
They're going after the whole thing.
Okay.
That's what it is. They throw out the
And if
whole,
you don't pay the whole thing, you're
you lose the house, foreclosure. Yes.
foreclosure. Okay. That's
Does that work?
what I think. And but your credit is just going.
Yeah, and then you call me. So, yes,
That's what happened with everybody with
Exactly.
the crisis,
that's exactly it. They stopped paying and boom, they took their houses. Not because of 4,500, but because of the balance. Foreclosure, yep.
But you're saying like 3 months, right? Or 90 days
To go to
Whatever.
court.
to go to the court. But why people stay like with the foreclosed for so?
Because, like I said, traditionally the court takes 1 year, so 12 months to 13 months to, from the first default
Mm-hmm.
to losing the house, 12 to 13 months, that's the process. But because of the crisis, there were so many that banks got flooded, attorneys got flooded, and courts got flooded with. All right? So it would take almost 3 years, or it's taken an average of 3 years.
What happens?
Why interrupting the camera? He came in quiet,
Sorry. Just speaking to Richard.
Dick. So,
We call him.
no, I was,
Oh,
isn't that your nickname?
technically, it's kind of like a nickname.
Jesus. All right, did you guys understand
Yes,
this?
Yes, I understand. Like,
Good? Crisis?
Yeah.
Life
Like
and
an amortization table.
Not yet.
Kind of looks like.
You like mine?
That's like a graph of an amortization table.
It is. Good job. You want to try to step up?
Hmm?
There you go. Talk about assignments and stuff like that.
Letters are actually pretty big.
Yeah, thank you.
No, because I can't read. my vision isn't the greatest.
I know. You can always use your fingers.
There it is.
Zoom in, zoom out.
Alright, so I'm guessing we're in the time of the mortgage, right?
Yep.
Alright, a note or bond is usually a negotiable instrument. As such, it may be sold by the lender to a third party or assignee. You had a mortgage, right?
Mhm.
Have you ever had your mortgage been sold multiple times right after you
What?
closed? Yeah.
Can't hear you.
Plenty of times.
Can't hear you.
So oftentimes it happens all the time.
Yeah.
People try to free up their trade lines so they can open up more mortgages. An estoppel certificate executed by the borrower verifies the amount that remains to be repaid and the interest rate. Okay, on payment in full or satisfaction of the debt, the assignee is required to execute the satisfaction or release of the mortgage. In the event of foreclosure, the assignee, not the original mortgagee, files the suit. Okay? If you don't pay your mortgage on time, bank can foreclose, then they take over the property. So every single penny, every single dime that you put into this mortgage, into the house, the down payment, all gone if you don't make the appointment on time. Go ahead. Mr. Quinzella.
Contested number one.
Mr. Quinzella.
So,
Uh-huh.
it says assignment of mortgage.
Mhm.
So the bank assigned the mortgage.
Okay,
So you went from one lender to another.
correct.
So you just read that at the end of foreclosure,
Mhm.
who goes after the mortgage? Is it the original or the one that was assigned to? Isn't that what you just read?
Yeah, it's the one that's assigned to, the one that currently holds it.
Thank you. I just wanted to confirm that.
Okay. Why would the original go after if he has no interest in it anymore?
No, for us it's logical, but when you're explaining,
Gotcha. Did you guys understand that when? Yeah, okay.
I didn't.
I'm not gonna lie, I need to explain that one more time.
You need me to explain that one more time? Okay.
Cause
I have a car.
Mixed it in.
I have a car.
Okay.
I sold it to you. You paid for it in full.
Okay.
Now you leased it to her. You leased it to her,
Oh,
so she's
okay,
paying
okay.
you, right?
Uh-huh.
If she stops paying the lease, why would I go after her when you're the one that has full interest in the car? Same thing with the property.
Good example.
that was a great example. I would have used landlord, but okay.
Right?
No, but it's fine.
I try to use it in a sense because he doesn't have a mortgage. He's never had a mortgage. So why not talk about something that he's had?
You never had a mortgage. That was like,
He ain't never gonna have a mortgage either.
you never had it, doesn't have, never
Incorrect.
had it,
You're
never
going
will.
to have a mortgage.
Never will.
We're gonna get you a property this year.
Oh, thank God.
Seriously.
I'm the realtor, he's the finance guy.
That's it. Recording mortgages. The mortgage document should be recorded in the proper office of the county in which the real estate is located. This establishes liens property over future mortgages or other liens. To be recorded, the signature on the document must be acknowledged before a notary public. Okay?
Cool. I already explained priorities, so it's okay.
Yep.
You don't have to explain.
You don't want me to explain it again?
Priorities?
Yeah.
Who gets paid first?
Tax.
Taxes. Who gets paid second?
The person holding, well,
Mortgage.
yeah,
Original mortgage.
What if there's three mortgages?
it depends which one records first.
Whoever records first. Yes.
Right. First, yeah.
So if you default on the second mortgage, can the second mortgage foreclose?
No.
Well, actually, yes, they can.
They can. but
It's just
the
going to be difficult because the first will trump.
Right, yeah.
That's another word. We'll take over.
That's right.
Wait.
Little brain. First mortgage goes, nope, I'm daddy here. Wait, can you cut that out of the? Can you cut that out of the class?
That your mortgage says I'm daddy?
Yeah. Interest rates.
Bobby.
Interest rates. This is my favorite, actually.
I hate this one.
That's
Usury. The charging of an unreasonably high rate of interest is known as usury. Various state laws protect borrowers. The federal government, in an effort to make mortgage money freely available, has exempted most regular lending institutions from mortgage limits. Two private sources for mortgage money, however, are bound by state usury laws. The seller who takes back financing or holds a mortgage, third parties, such as real estate broker, grandfather, investor, who may lend the buyer money to purchase someone else's property. Usury laws. Does anybody know what that is?
What is usury?
Yeah.
I heard it's
Like
like being
abuse?
raped by the bank.
It
Abuse.
is. It is.
Yeah.
So
And
they actually have laws in place that banks cannot charge more than a certain amount of interest for even like credit cards, for example. Credit cards are bound to a limit. So if you take a look, even with the worst credit, doesn't matter what credit card you go to, they will never surpass a certain amount. Go ahead, sir.
But that's credit card. Here it says mortgages.
Same thing, man.
No, most lending institutions are exempted from limits
Right.
when it comes to mortgages. That means they can charge whatever.
They can charge whatever they want.
Mortgages.
Mortgages.
That's your house, your biggest investment, and that's what they can do?
Yep.
Isn't that messed up?
It is messed up.
Because then you're just reading that private sources for money, like if I lend money to you, I gotta be careful with what I charge.
That's exactly right.
So the bank could do whatever, but I cannot.
I don't like banks, man. I just work for them.
It's good.
Actually, depending on the loan program, they are bound to certain limits. They cannot go over a certain interest percentage based on a certain interest rate that's set by, whether it's like, for example, Freddie Mac, Fannie Mae. You cannot go over a certain amount. So when interest rates go bad really fast, what happens a lot of the time is they get stuck at a cap, and the only thing they can do is charge points for that cap.
So that will be here, but a cap is, it's fine.
Yeah.
But a cap is, the limit.
It's like a ceiling of the interest rate. That
Okay,
they
so
can't
every
go
time you
higher.
hear cap is a limit.
Then when we get into the next chapter, I don't know, do they talk about QM and not QM loans? They do? Okay. So when a private third party, someone, not the seller, and not an institutional lender, makes a mortgage loan, it is essential to find out ahead of time what usury limits apply. A mortgage that charges an illegal rate of interest is not legally enforceable. The borrower might have a good case for not repaying the debt at all.
Mm-hmm.
Maximum rates are set by the New Jersey Commissioner of Banking and are changed as the money market changes. So obviously, as the market goes higher, the limits go higher. You know, if you take a look at where we were, for example, 2-3 years ago, when people were offering threes, low threes, mid threes percentage on mortgages,
Mm-hmm.
it's no longer a thing anymore. It's a thing of the past. Prepayment is any amount paid before it is due. Most common example is the seller paying the remainder of the mortgage loan, so the seller can convey the property to the new buyer. Under New Jersey law, an institutional lender may not impose a prepayment fee or penalty if a mortgage is fully paid off earlier than what was originally planned.
That's on the test.
Yeah. Anybody know what a prepayment is?
Pay in advance.
Prepayment of a mortgage? What do you mean pay in advance?
You pay the loan in full.
Correct. So you pay off the loan.
Okay.
So before, there were prepayment penalties. And even in certain cases, you will find some loans out there, that, for example, commercial loans and private loans, that they actually charge a prepayment penalty if you pay off quicker than what you originally put in the contract. So if you have like a 30-year mortgage, for example, or a 25-year mortgage, sometimes they'll have like the first 7 years there's prepayment penalty, and they'll call what's like a step down. So the first year will be like 7%, and then second year 6%, 5%, 4%, 3%, all the way down to 0. So, any questions on the prepayment?
It's pretty self-explanatory.
Okay, cool.
It's in the name, prepayment. You pay ahead of time, you get penalized.
There you go.
But in this case,
In this case, they don't do it.
Yeah.
It's law.
Under New Jersey law, it's
New
no
Jersey
longer
law
a thing
for mortgages,
for mortgages, for residential mortgages.
gotta be very clear about that
Yes.
these days.
For a qualified mortgage. Let's put it that way.
Qualified.
And you sure that's in the next chapter, the qualified mortgage thing? It's not?
It is.
Oh.
Kind of.
All right.
It
So
is,
commercial,
kind of.
so commercial loans aren't abide by this, don't have to abide by this.
Commercial loans is like the Wild West. They do whatever they want.
Mhm.
First and second mortgages. So mortgages and other liens normally have priority in the order in which they have been recorded. A mortgage on land that has no prior mortgage lien on it is a first mortgage. When the owner of this land later executes another mortgage for additional funds, the new mortgage becomes a second mortgage or junior lien when recorded. The first mortgage has prior claim to the value of the land, pledged as security. A home equity loan is usually a second mortgage. All right. So
Second.
normally, even when you go ahead and you open up a line of credit, they still need permission from the first mortgage lien holder to put that second lien on there.
Mhm.
You know?
Well, we just went over that, yeah.
Oh, you did? Okay.
Mhm.
Sorry, I wasn't part of that class.
No, I'm just saying, I'm confirming what we just said.
Okay. All right, so the priority of mortgage liens may be changed by the execution of a subordination agreement in which the first lender subordinates his or her lien. The holder of the first mortgage would then drop back in priority, allowing a later mortgage to move up. This is sometimes done to allow further financing when the first lender feels the additional loan would benefit all concerned.
An example.
You would do like a cash out refinance when you already have a line of credit out on the house. And then you have like a regular conventional style mortgage on the house, and the line of credit would kick back into a second mortgage lien position. But they also have to agree to it.
Okay.
Otherwise, you would just have to pay off the whole thing and
Mhm.
put the new mortgage as just the only mortgage and first mortgage. Satisfaction of the mortgage lien. So when all mortgage loan payments have been made and the note paid in full, the mortgagee is usually required to execute a release of mortgage or satisfaction of mortgage.
And what does that mean?
That means that once you've paid off the mortgage, the first lien holder has to release their lien and give you property free and clear. Taxes and insurance are not your problem.
Next page.
If you have a second mortgage,
You don't need me to read the highlighted part?
No, not on this one.
If
if
you have a second mortgage, you still have a lien on the property.
there's
So
still a lien on the property.
you're not free and clear.
Okay.
Well,
No, I mean, well, the first mortgage would be
is the mortgage a lien?
the original. No,
Yes.
Yeah,
wait.
remember?
Yes. So let me ask you something. Let me ask you something. You have a first mortgage and a second mortgage, right?
Okay.
So the first mortgage is paid off. Where do you think the second mortgage goes now? Bumps up.
Bumps up. So
Now their
then,
first mortgage goes.
so then, so the title
To them.
goes to them, and then only after that will the
There's-
title be.
This is not a car, so the title doesn't go anywhere.
It doesn't go anywhere.
Deed doesn't go anywhere.
Oh, yeah,
It's recorded, one gets released,
Yeah,
Uh-huh.
so automatically,
they move out the record.
but that's public records. There's no like, hey, let's make a change now. No, one is paid off. That means that the next lien is whoever recorded next.
Right.
Does that make sense?
Mhm.
Once this is paid off, is whoever recorded next, and so on.
Okay.
This is automatic. We don't have to do anything. It's pecking order.
That's it. I'm glad you asked that question.
And I'm sorry for interrupting your explanation.
No, it's okay.
Next. Next
All right,
page.
where are we going? Assuming a seller's mortgage?
Yeah, so assuming and buying subject to the difference between these two.
So you want me to read assuming a seller's mortgage?
And the buying subject to, and explain both. The difference between them.
All right. Assuming seller's mortgage. Anyone who purchases real estate that has an assumable mortgage on it may be able to assume it and agree to pay the debt. The new owner then becomes personally obligated for payment of the debt. If the mortgage is foreclosed in such a case and the court sale does not bring enough money to pay the debt in full, the deficiency judgment against both the assumer and the original borrower can be obtained for the unpaid balance. While the assignee has become responsible for the debt, the assignor retains secondary liability if the lender cannot collect the full amount owed from the assignee. When a mortgage is being assumed or paid off, the bar requires a statement from the mortgagee detailing the amount currently due. This reduction certificate is often and wrongly referred to as an estoppel certificate. Okay, anybody have any questions on that?
So what you're saying is that the person who, so if I assign it to my friend here,
Bruno. thank you.
Bruno, and he can't, we're both not responsible for the debt, and he can't make the payments anymore. They go after both of us, but I'm still.
Yep, just like the assignment of
Just
the
the
lease
assignment
that
of the
we
lease.
spoke about, yeah.
So it's
Okay.
like a cosigner.
No.
But they go after me first before they go.
Well, you're talking about cosign in terms of liability, first and secondary. So the primary signer is fully liable, secondary signers, right? In this case, it's an assignment. Remember, he was drunk, he signed the
Yeah.
contract, and then later on, he decided
Right,
to
right.
can't buy, so then you give it to somebody else. That was an assignment.
Assignment.
This is my contract, wholesale, right? For
Mm-hmm.
instance, it's an assignment to him. I did not release liability from me unless it was novation. Remember that?
Yes, yes.
So I assign it to him. If he does not buy, I'm still responsible.
Right.
Okay.
So in this case, it says, assuming somebody's mortgage is like assigning the deed, right? Transferring the deed, but you're still paying on the original mortgage that he had.
Mhm.
So if you default,
I'm
you
still
get
liable.
stuck too.
Yeah.
Was that correct? I'm sorry.
No, that was very correct. Unless you refinance the mortgage out of his name into your name, then it's a different story.
Is that allowed?
Hmm?
Keep going. Thank you.
Yes, it is. Put your name on the deed for 6 months and you can refinance it out of it conventionally.
Ah, these tips. Swish.
There you go. You guys are learning some stuff here, man.
That's good. That's good.
Buying subject to a seller's mortgage. Anyone who purchases real estate subject to a mortgage is not assuming a note or bond and is not personally obligated to pay the debt. The new owner has bought the real estate knowing that he or she must make the loan payments and that on default, the lender forecloses and the property is sold by court order to pay the debt. The sale does not pay off the entire debt. The new owner is not liable for the difference.
Mhm.
It's like $1.
In both of these, okay. So in assuming a seller's mortgage
Mhm.
and buying subject to a seller's mortgage, in both of these, there's a new owner of record, so a new person on the deeds.
Mhm.
But in both of these, the mortgage is still under the seller's name. So definitely not a short sale.
Okay.
The difference between these two is that when you assume somebody's mortgage, you assume liability as well. When you buy subject to, you never put your name on the mortgage.
I see.
Therefore, the seller is fully liable. The new owner, the buyer, is not liable. In assuming a seller's mortgage, the buyer has liability. In buying subject to, the buyer has no liability. In both of them, the seller retains liability,
Kind of sounds like a lease with option to buy.
for instance. It's not under your name, but you have the option, right?
All right, where am I continuing?
To the
Alienation
right,
clause?
Yeah, the aliens.
We all
That's
knew
what I
this
said.
day would come, man.
You knew they were coming. The
I
aliens.
knew, man.
We'll call them movies.
Come in, please.
Frequently, when a real estate loan is made, the lender wishes to prevent some future purchaser of the property from being able to assume that loan, particularly at its old rate of interest. For this reason, some lenders include an alienation clause, also known as a resale clause or a due on sale clause in the note. An alienation clause provides that on the sale of the property, the lender has the choice of either declaring the entire debt to be immediately due and owing or permitting the buyer to assume the loan.
Okay, so due on sale clause, what does that mean?
Means that somebody else steps into the picture as a buyer. The current mortgage holder can make everything due right today. They don't have to wait until the contract that they originally signed with you for 30 years, so you don't have to wait till your 360th payment. Everything becomes due today. Balloons.
So similar to what you have there on the board, that was more for default and foreclosure. But what we're saying is, at the time of closing, that transfer of title, there's a new owner, like you said,
Mhm.
the whole balance of the loan must be paid off. That's why usually we get a payoff quote
Correct.
or a payoff letter, right, to explain what the balance is with interest and all that stuff. So that the new owner gets his own mortgage if he's mortgaging, right?
Mhm.
So the alienation clause or due on sale clause is once there's aliens on the land, like foreigner, somebody that doesn't belong to our original contract, then you gotta pay off.
When a borrower defaults in making payments or fulfilling any of the obligations set forth in the mortgage, the lender can ask the court to order a foreclosure sale. The mortgagee must search the public records to find other parties who have claims against the property and to find out whether tenants are involved. All must be notified that the suit is in progress. A lis pendens is placed in the public records, and a public auction, a sheriff's sale, is advertised in local newspapers. Okay, so before a foreclosure can take place, they normally issue what's called lis pendens. Normally, when you start, when you're already 90 days late on your mortgage, normally lis pendens is issued, but they already start the foreclosure process. And then, in order for them to foreclose on the property, they have to advertise a sheriff's sale. A lot of times, you can actually go on the county website and you can find out what properties are already going into a sheriff's sale and when they'll be there. It's actually pretty interesting. You guys should attend one day.
Within the auction, oh yeah, absolutely.
Yeah. Even if you're not going to do anything, just sit there and just
Actually, go there and get the observer card. Don't get the bidding card.
Mhm.
Because it gets exciting, you know, and then you raise your hand and then like, oh,
Yeah, that's
you
right.
won the bid. But if they see observer card, you're like, yeah, next.
That's right. Or they just make you sit in the back.
That's it.
Yeah.
That's what they did to you, put you in the corner.
They put me in the corner. I couldn't see anything, but I could hear, so I still felt like I was there.
Wait, you were there.
I was there.
Okay. But you should go. All of you should get
Definitely.
Probably an alien.
I think everybody that gets involved in real estate should attend one just to see what it is,
Mhm.
what it's like, so you can be able to explain to your buyers how it is. You never know. No, but you never. If you're really going to be serious about real estate, you help somebody go through a sheriff's sale. They're more than likely going to be selling that property,
when they sell, yeah. Or renting with you.
right? You want to make sure that you build that relationship, because most of the time, these people that go to sheriff's sales, they're the ones that have the cash. People have the cash normally don't stop at one. It
It'll be
continues.
fine.
You build that relationship, and you start building more connections.
Unless they have somebody else's cash and then they screw up. Next.
Exactly.
Back
Back property taxes and special assessments have first claim on the property, and whoever buys the real estate has to pay them. Junior liens to the one being foreclosed, however, are wiped out by the sale. For this reason, junior lien holders, usually those with second mortgages, construction liens, and the like, attend the auction to protect their interest. If necessary, they may bid the price up high enough to pay their claims as well. If someone else bids higher, they can expect their debts to be paid out of the proceeds. So actually, these junior lien holders, they actually send people to these auctions to start enticing people to pay off their debt.
So it raises up the value of the bidding.
So that they can make their money.
Correct. And
Exactly.
then there's the people that are fake investors or learning to be investors, and they bid high enough to satisfy that, but then
Mhm.
screw themselves up because the property's now not worth it.
Exactly.
You guys already know at this point what junior liens are, right?
Mhm.
Junior liens are secondary liens.
Secondary.
Okay, all right, just wanna make sure.
Mhm.
So if there's not enough money to satisfy, what happens to the junior liens?
They get squat.
They disappear, they get
Yeah.
nothing.
They
Because
lose.
the first lien.
You guys remember that in chapter 8, 9, we went over this as well? Order, no, I'm sorry, chapter 7. We went over the order of who gets paid first,
Mhm.
Yes, yes.
taxes, whoever recorded first, whoever recorded second. I'm talking about construction liens I put on the board,
Yes.
right? You were not here.
No.
So construction
6
liens,
and 7.
so you get paid in the pecking order, who's first. So if there's not enough money to satisfy the junior ones,
Nobody else.
they get nothing. And there's no recourse for them. They can sue you on the personal level, but there's no recourse as far as the property, of what the proceeds of the property are.
Mhm, okay.
But once it becomes an unsecured debt, that's when people go into bankruptcy and boom, there it goes.
Successful bidder must pay cash, at least 20% at the auction, and the rest within 10 days. 10 days.
Mhm.
They go up to 30 days.
Nope.
Until a sheriff's deed is delivered to the buyer at the end of the 10 days, the defaulting buyer can redeem the property by paying the full amount due, including back taxes and legal costs. After that time, no further right of redemption exists in New Jersey.
So
I got you.
Okay.
So they
what you were saying about the 30 days is they do extend with the penalty and interest.
Right.
But the reality of is 10 days.
And they actually give you extensions, like they can go, I think, up to 90 days.
Correct.
They give you-
But you're paying penalties over that time.
Right.
Right. But explain, so the successful bidder, so whoever wins the auction,
Whoever wins the auction has to put 20% down at the auction.
cash?
You gotta bring, normally what they do is they bring a bunch of official checks, so they bring different increments, like 20,000, 10,000, 5,000, 1,000, and then they go and they put the bid, and 20% of the purchase has to be paid there with those checks. Okay, and then
You
they
don't
have
become
to,
the official owner until,
until 10 days later.
correct. So sheriff's deed is only issued 10 days after the auction.
Right, because the current owner can pay off everything that's due if they come across the money, like the Powerball, let's say they win the Powerball, and they want to keep the property, they can pay it all off.
That's it?
Some other states, the former owner has a statutory right of redemption for up to 1 year after the foreclosure sale. Thought I was late.
Well,
All right, you go into deed in lieu of foreclosure?
what's deed in lieu? What does in lieu mean?
In lieu, like limbo.
Like what?
In limbo. I'm just kidding. It's about to go into foreclosure.
Okay, so deed instead. I want you guys to write instead. In lieu is in exchange or instead of.
Yeah.
So deed in lieu of foreclosure is like cash for keys, like an exchange. You give the deed to the bank instead of them proceeding through court for 3, 4, 5 years and so on.
Mhm.
Right?
Sure. Some people leave the keys in the mailbox and they say, there it
You
is.
can get it.
That's exactly right.
Okay.
So an alternative to foreclosure is for the lender to accept a deed in lieu of foreclosure from the borrower. This is sometimes known as friendly foreclosure because it is by agreement rather than by civil action. The major disadvantage to lenders is that it takes the real estate subject to all junior liens, while foreclosure eliminates all such liens. However, because foreclosure is a time-consuming and expensive procedure, lenders will sometimes agree to accept a deed in lieu. Okay. Anybody understand what that is?
So what's the advantages of deed in lieu?
A deed in lieu.
Uh-huh.
The bank doesn't have to go through all the pricey,
Court
Uh,
fees,
huh?
Like the court fees, court
Exactly.
process.
exactly, because they do have to have a legal representation in order to get everything done in court, so they don't have to go through all of that. You or person
Voluntarily give,
as the owner of the house, literally sometimes what they do is they put the keys inside the mailbox and they say, here it is.
it's like voluntary, like repoing your car. Like instead of having them repo, you just voluntarily give it in.
Exactly.
But what about the junior liens?
Junior liens are not satisfied because it's not in a foreclosure.
They're not happy?
Huh?
They're not happy, they're not satisfied.
Oh, they're very satisfied. The junior lien holders are like, yes. But
But the junior liens are still on the property.
yes, they are.
Okay.
Yes, they are.
So that's why they're still happy.
So it's kind of like there's pros and cons to it. You
Yeah.
know? Pro is the bank doesn't have to, the first lien holder doesn't have to go through all the whole lengthy process of going to court and getting people out of the property. Especially if it's owner occupied, it can take forever, especially in the state of New Jersey. Here, just like that, it's done. Okay? I elaborate
But what's the
more?
cons though?
Huh?
What's the cons? I see no cons here. I see all everything but good for
Well,
the what do you call it? For
the junior lien holders are still there.
Well, okay. Oh, the other way it doesn't.
It doesn't.
I got you.
There you go.
You saw the light bulb? You saw right there, like,
That's right.
It's happened. How many
He's gonna
times
pass
has
that
that
test on
already?
Monday. He's gonna pass the test on Monday. There's faith.
It's happened at least 3 times.
Some hope.
already.
Okay, my favorite. Just kidding.
I know. You hate this.
I hate this. He knows.
I know.
Short sale. Ready,
happy
guys?
with the basil.
During the recent recession, rising unemployment and falling prices left some homeowners unable to make their mortgage payments and unable to sell it for enough to pay off the whole debt. That situation, lenders sometimes agree to a short sale rather than foreclosing on the loan. The lender would agree to accept whatever the house bought on the market and remove the mortgage lien so the title could be transferred. Can anybody explain what that means?
Somebody help me.
I have no idea what that means. No, I'm just kidding. Can somebody tell me why it would be more beneficial for a bank to go through a short sale rather than a foreclosure?
Because they're still gonna get their money for the property.
Mm-hmm.
Well, it's gonna get some money.
Well,
Yeah.
Rather
depending
than
on
no
how back far pay you are, right?
Yep.
Like if you're into it 15 years and they owe 160 and you sell the house for 160, you're basically making your money.
If you owe 160 and you sell for 160, it's not a short sale. Short sale is selling for less than what you owe. So you owe 500,000, you sell for 300.
Okay.
Sorry, teacher.
The bank is going to lose money
Yeah,
on the purchase because they're not going to be fully paid, bought out. But also they don't have to go through the whole legal thing of going through a foreclosure. And not only that, who's to say that somebody's actually going to buy the house at the foreclosure event?
And if they do, at what value?
Exactly. Here, they don't have to go wait until that time, which could take years.
Mm-hmm.
They're already taking care of business. They're getting paid. They're cutting their losses short ahead of time.
So, short sale, can you come up with another
Explanation.
Another explanation?
for short sale?
What didn't you understand about my explanation?
I didn't see anything he said.
No. Obviously, what I said, maybe something you didn't understand. So a short sale. We went through foreclosure, right?
Hmm.
We went through foreclosure.
Okay, no, I don't know.
Foreclosure.
Okay.
Foreclosure. Person stops
That
making
right there.
payments.
Okay.
Person stops making payments, right? The bank wants to get their money. So they issue the spendent, in which they start the foreclosure process until they go into the sheriff's sale, right? From point A to point B, the bank wastes a lot of money in legal fees, and not only that, they get to the foreclosure, and they don't know what they're going to sell it for. They normally start off with like the minimum bid in order for somebody to actually take it, but who's to say that it'll continue on, and they'll find, like, for example, rookie investors, like he said, who will really want the property and they'll overpay. In that case, the bank actually has a benefit. But if you can cut all that time short, right? Short sale.
Time short.
So right here,
selling short.
instead of like 7 years, so would you say is like a typical foreclosure?
No, it's 3 years.
It's 3 years?
The average. If we
But it
don't
can
do
go
it,
up to 7.
I can bring you up to 10, 11 years.
Yeah.
But if you don't do anything else right now, is roughly 3 years.
3 years, okay.
Without
Let's-
any loan modification, short sale actions, or anything. So 3 years.
Let's do that, 3 years, okay? So now it's a 3-year process. Now, imagine if Tony owed you money, and you know he wasn't gonna pay you anything,
Oh, he's dead.
right?
She wanted
So-
to shoot the landlord.
He,
Wait, let's cut that.
imagine you could get a piece of it, but you have to wait 3 years. And all of a sudden Tony goes, hey,
For a piece? Damn.
hey, I give you this today, and we'll forget about this. That's kind of like what happens with the bank. So the bank, instead of having to wait to go over here where it has uncertainty, they stop here, they cut their time short. That whole lengthy process of paying fees, legal fees, and getting things done until they get over here, they also save some money and they recoup some of their losses.
So they're,
They know what they're gonna make.
so they accept the money they have to give it to them.
Exactly.
Okay.
It's kind of like, give me something rather than nothing.
So
Yes.
exact discount.
That's what short sale is. It's a
It's
discount purchase.
Discount purchase.
Discount purchase. No bank wants to lose money, but it's also an enticement for them because instead of losing a lot more money, they already know what they lost.
And then they can hook somebody else to continue paying.
If they're the mortgage holder, yeah.
They're the mortgage holder. In this case, the property is sold, so the bank is out of it.
Oh, okay. So,
Both the seller and the bank get out of it in the short sale.
okay.
Mhm.
And then the new owner comes in with their new bank.
Correct.
Gotcha.
Exactly.
Do on sell clause.
There you go. Was that better? Was that a better explanation?
No,
Rarely, the lender might then seek a deficiency judgment for the shortfall, often through the debt has simply listed as satisfied. The lender reserved the right to approve or disapprove the sales contract, and the process was often lengthy and complicated. But for a homeowner facing foreclosure, short sale did somewhat less damage to a credit record.
So the advantage of the short sale is not screwing up my credit that much.
Exactly.
Is that the only advantage?
Well, if you ever want to buy another house, you don't have to wait so much time.
How much do you have to wait if it's a foreclosure?
We're talking about FHA, or we're talking about.
No, that's what I'm saying. It depends. So these are things that they should know as salespeople,
Mhm.
because for me, it's a selling point.
Right.
When I go to a seller and say, "Hey, you're losing your house," right? There's one that we actually saw when I was training you, right?
Mhm.
We saw a property. I said, "Let's say, go knock on that house and say, hey, listen, if you let it go to foreclosure, you could be up to 7 years without being able to buy a house, right? But if you do a short sale, in roughly a year or two, you can buy a house."
Yep.
It's a big difference.
Mhm.
Like you're stuck for the next, correct me if I'm wrong, you're stuck for the next 7 years in a foreclosure. But if it's a
Or if
short
it's
sale,
a
some
FHA,
lenders, even 1 day out of the short sale, and they allow you to buy a house. Higher interest, higher down payment,
Non-QM loan,
yeah, but they allow it.
Then they're done that.
non-qualified mortgage.
So
Yes.
So the advantage of not screwing up your credit is also the advantage of being able to purchase now versus later.
Mhm.
So you can get back on your feet quicker versus being a tenant for 7
Years.
years. Yeah. Does that make sense?
It's deficiency judgment.
Foreclosure.
If the start over. If the foreclosure sale does not produce sufficient cash to pay the loan balance in full after deducting expenses and accrued unpaid interest, the mortgagee may be entitled to seek a personal judgment against the signer of the note for the unpaid balance. Such a judgment is called the deficiency judgment. It may be obtained against any endorsers or guarantors of the note and any note owners of the mortgaged property who may have assumed the debt by written agreement. If, on the other hand, there are any surplus proceeds from the foreclosure sale after the debt is paid off and expenses are deducted, they are
Thought
paid
you
to
were
the
rapping.
borrower. Wrong deficiency judgment,
Wait,
the
how
amount
did
of
you get a
money,
license?
the amount of money that the bank loses, they write off as a loss to that person, and that person signs a form, I think it's 1099R.
Mm.
Is it 1099R or 1099C?
See,
1099C.
1098C actually.
1098C, okay. 1098C. So what happens is
Thank God I did taxes.
once the bank loses its money, accounting, for every credit, there's a debit, right?
Mhm.
So the bank took a loss. So they took a debit. Who's getting the credit? The person who lost the house.
Yeah.
So now they have to write that off in their taxes.
What?
So
What are you laughing at?
It's like that, credit again?
debit, credit.
Yeah.
For every plus is a minus, right?
Mhm.
Right. So credit is plus, debit is minus.
Mhm.
Look at your bank statement. Minus, 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 minus. So, the deficiency judgment, remember I said that a short sale, just like a foreclosure, is the property you owe 500,000, but it gets sold for 300.
Mhm.
There's a difference of 200,000.
Mhm.
That negative 200,000 is a debit on the bank side, and that's what they come after for, the deficiency judgment. If they're able to sue you for that money, great, they get paid. If they're not able, just like he was saying right now,
Take a
they
loss.
write it off, they take a loss.
Yeah. They're right.
Mhm.
And if it's a loss on their end,
They love
it's a
it.
gain on yours. You got it?
They love it. Don't get it ever twisted. The bank loves taking that loss.
Of course.
Oh, yeah.
And then you pay taxes on that money that they lost.
Mm-hmm. And they don't have to pay taxes on that money.
Yep.
From which they gain from all different types of fees that they charge other people.
Not only the fees, insurances, and all that stuff.
Yeah. They probably get paid that money back anyway too.
Yeah, they win that money 6 different ways.
Mm-hmm.
Anyway, so before you move forward,
Mhm.
did you guys understand this? The deficiency is a loss, so that you could best get sued on, okay?
We're almost done, guys. We're almost
So
done.
Now, on the other hand, as you were reading, that there's
Summary.
a surplus. What is a surplus? If the auction brings more money than what you owe.
Then
So
the-
you owe 100, but the auction brings 150.
the lien is satisfied.
But what happens to the extra, the surplus?
It goes
The
to the
50,000.
junior.
No, after paying everybody off, there's a surplus. Surplus means it's owed to the person that lost the house.
Oh, okay.
The problem is, in a foreclosure, it takes years. So there's a bunch of documents going back and forth. Okay? After the third or fourth document from courts, most homeowners stop reading it. Like, I know I'm losing the house, stop out, they don't want the stress.
Right.
So they stop reading it. The very last document, the writ of possession, where it says, hey, a writ of execution that says, hey, sheriff, sell this house. And upon the sale, all the monies belong to the plaintiff, the lender, but any surplus belongs to the defendant, the homeowner. It's written, that last document. Okay? But nobody reads it.
Mhm.
The sheriff holds that money for that person.
Dancing on your shoes.
Trying to find.
That's even
I'm just kidding. All right,
real estate owned.
guys, we're almost done. We're this home stretch right here.
Home stretch, there you
A
go.
home stretch. In recent years, many homeowners owe more than their houses can be sold for.
Mhm.
Situation often referred to as being underwater with an upside down mortgage. When the mortgage is foreclosed, no outsider will bid enough to take the property and it defaults to the lender. Real estate owned, or REO, is used to describe such properties acquired by lenders through foreclosure. Some real estate brokers specialize in handling REO properties for lending institutions. REOs
With milk?
is amazing.
I know, with milk.
Milk.
Oreos.
The REOs are amazing. I've actually gone into an REO home. The bank will take care of that property for the person that's going to buy it, basically. Has carpets, they'll clean up the carpets, they'll do everything to sell that property. Actually, I think Pedro actually just, I did a mortgage with him where he did the inspections and everything. They put in a brand new roof. Put a brand new roof for the buyer.
Oh, which
No.
one? The Danella?
Yeah.
Oh, I didn't know.
Yeah, brand
You
new
got all
roof.
that? No.
Yeah. And it was a good roof too. It was not like cheap stuff they put. Stuff
I
they
like
like.
when they have oil tanks.
They'll remove it.
They'll remove it, huh?
They'll remove everything.
Which is very expensive.
Yes, it is. It can be. Could be
That's contaminated.
it could be 3,000, 5,000, or 50,000, and the bank will take care of it for you, no problem. Just because they don't want you to come back and sue them later on.
I think the house that we bought was one of these.
It was.
They removed.
They moved the tank.
Yeah.
Yeah, I think it was an REO.
All right, so REO means real estate owned by the bank.
Mhm.
So after foreclosure, if nobody bids high enough, the bank keeps the property in their inventory and then try to sell it later on.
Yeah.